Okay, good evening, everybody, or good afternoon if you're on the West Coast. This is Jim, the option professor, and I'm going to give you a weekly update on what's going on in the markets. Also, I'm going to show you some option ideas, and I'm going to explain how you could get some individual coaching if you need any help on the ins and outs of option trading. Quick background on myself. I'm a graduate of Boston College. I've been in the options business for decades, and I've done seminars throughout the country and Canada over those decades, helping thousands of investors understand options quite a bit. Today, I am going to be explaining the uses and risks of options. And of course, I'll be sharing my opinions. But what we're not going to give is any advice. That's not what we do. We just share information. And of course, options involve risk, not right for everyone. So I always encourage people to go to their brokerage firm and find out what they have for suitability and risk tolerance before they make any ideas about option trading at all. So again, without further ado, let's get started. I'm showing you a chart right now on IBM because I am going to explain a little bit about how I try to follow how the markets are going. Now, these are moving averages that I came up with. So these are my moving averages. Everyone's got their own cup of tea. This is my cup of tea. The red line is and green, and then blue, then purple and gold. Basically, okay, my interpretation is the key, but basically the red line's telling me if the trend changes. The green and the blue are telling me if we're going to go on a long run or not. And then the purple is the garden variety reversion to the mean. And then the gold is a extreme reversion to the mean. And as you can see with IBM, we had an extreme version to the mean in April, but we just had a even more of an extreme today. So this is also a good example of how things that are going up don't always go up forever. And when they could turn and they could go down very sharply. So basically, I'm trying to just give you a quick briefing on what I'm doing here. With regards to in the beginning of the year, September 2024, your red line's up, your green line's up, your blue line's up, so we're going up. Then the red turns down, but blue doesn't. And you've got the purple underneath, so we're not going to be going too far. Then we rally back up. And then, of course, we come back down. And this is when it gets interesting for me, because this is where we've reverted to the mean. We have a consolidation of my averages. And we got the blue line pointing up, which is one of the main lines I follow. So the likelihood, in my view, that this thing was going to go up was extremely high. And of course, option prices, when the market has corrected on the call side, and when you've consolidated, are going to be much lower than they would be normally. So I would call it lower priced call options with a correction behind you, with a trend you believe is going to possibly explode on the upside because they had earnings coming out. That's a good recipe for taking action. Same thing over here in April when Trump got everybody to sell out of all their stocks. You went down to an extreme down here. Obviously, you could have taken a taste down here, but I would prefer for the red line to be pointing up and the green and the blue. And when that happens, I'm very confident we're going higher. And as you can see, once that occurred, the move to the upside was much more, shall we say, fluid. Okay, so we're not looking to trade every single day on every single thing. What we're looking for is setups that make sense. Again, most of what I'm doing is trying to buy options that are inexpensive, that are going to get very expensive, because my opinion is that the seller is not taking in enough premium for the risk he's taking on. And anybody who's sold options before, you know, you get your head handed to you when you're taking a small premium right before a volatility pickup. I know it because in my career, I used to sell options quite a bit. And whenever I got in trouble, that seemed to be the recipe for trouble. Lower priced options, lots of volatility around the corner. That's what I'm looking for. That's where my Periscope is looking. And I'm going to go show you some examples in just the last 2 months where we had some success finding that. And of course, that's why people subscribe to the letter, because they're looking for me to help them find things like that, which takes a lot of time, I can tell you, and it takes a lot of research, I can tell you. And that's why obviously people subscribe, along with the education they get as well. Okay, so here in May, that was a good time. Now, the last time you could really make a case for doing something was really in the 280 level. Can you see the averages converging right around 280 with the red line pointing down? Obviously, the possibility of a big drop was there. and you got a big drop after earnings. And then if it can't hold a reversion to the mean line at 260, the next place you're going is the gold line. And now you're way down here, right? So it could find some support in this neighborhood, but not until it got back above 240 would have had any interest to me. And even if it did that, again, we had a good bargain down here, but a bargain that got choppy, right? Once the red, green, and blue are pointing up, it seems like it's a much more fluid action to the upside or the downside. Can you see they're all pointing down right now? I also go to longer term graphs to get an idea of where we might be going. So this thing had a red line here that was going to stop around 235. So this is a neighborhood. Again, this 240 area is a neighborhood where it could stop. If not, the trap door could be mid the 210 area, right? Or if I go to the 5-year graph, the trap door could even be lower because, again, you need to get back above 250 to get back on the bicycle. Definitely 240, but 250 would get me back on the bicycle because just like down here, they got everybody to get out of their stock. The blue line was rising. Once you got back above blue, it was easy money after that. So if we were to get back above 250 and the news changed, it could open the door to the remainder of the year having a good time. But this thing's on the defensive. Make no mistake. And this is called catching a falling knife, which is not my game. But if it's your game, this is where the falling knife, has to stop in this 240 neighborhood and get back above 250. But what it does show you is what? It shows you that you could be merrily going along, thinking everything is fine with your lovely stock portfolio, and the advisors telling you, I told you this was the way to do it, and everything is lovely, and we've got green lights and blue skies. And the next thing you know, something changes. And all these people that bought want to get out the same day. And when everybody wants to get out the same day, the market maker says, you want out? It's down at 235 near the gold line. Go sell as much as you want. I'll buy it down here. So that's what's happening basically, is you're having an order imbalance where everybody wants to get the heck out of Dodge. And the only one who's taken the buy signal, who'll put up his own checkbook, is the market maker. And that's why he's decided that somewhere down here might be a spot where he could buy without feeling he's stepping in front of a freight train. Okay, so I just give you that idea because now we're going to bounce around from different stocks so I can show you where the setup was, where I liked it, where I didn't like it. Again, I've been doing this for a very long time, and I've seen all the different indicators, and we just came out of meetings where we have meetings all the time where everyone's got their own cup of tea. I base mine on the moving averages. They're based on time and price. Time and price are factual. They're not subjective, right? And then, of course, I like to look at the relative strength because once it gets above 60, we could accelerate to the upside. If we get under 40, we can accelerate to the downside. Acceleration is where you make money on the options because when you're buying them, like I'm doing here, I have a limited risk. And if I'm going to get a big gain, I need acceleration. And that's why I look at the RSIs because that's helpful as well. Well, good case in point. The RSI on this thing was at 48. Well, where was it up here? It was at 55. Then it rallied. Look what happened after it broke under 40, right? It broke under 40, and this thing has been in what? In big trouble ever since. So this thing gave you a break of the RSI under 40. The earliest would have been 265, but that's still $30 from where it was. So you can't say that that's not an acceleration phase. You get the point? On the upside, where was the RSI down here? It was in the 50s, right? What'd I tell you? Once it gets above 60, you can get an acceleration phase. Do you think going from this point here when it was at 60 up to up here when it's at 70 is an acceleration phase? I think so. And that's where some good money can be made. Okay, so that's what I'm trying to do. I'm trying to find things that are cheap where we can risk a little bit of money, or I can risk a little bit of money with the idea. And then, of course, if we're right, catch a good ride. And if we're wrong, we have a relatively lower cash risk. Okay. All right. So let's look around. Let me show you about the stock market right now. We're going to look at SPX. And let me tell you, okay, if we take out 6,200, obviously this is going to be a sayonara deal. We had a what? We had a full moon yesterday. So the mood obviously changed a little bit because we went up to 6,400, but we closed down. Here's the key for me right now, and it's the VIX. Why is the VIX so important? I'll tell you why. Because big money, institutions and high net worth investors like family offices, they sold out of all their stocks in April when the thing was crashing, and they've got to redeploy all that money. And that's when, but they're not going to do it until things settle down. So that's why they're not going to, this is where they got out. April. I mean, imagine having like billions of dollars in the market and the VIX jumps up here and the market goes from 60 something hundred down to 4,800. I mean, come on, you know. So they obviously deleveraged. Now, when did they start coming back in? I believe they started coming back in when we broke under the blue line on the VIX, which is around 25 and then 20. Because when the VIX is behaved, that means volatility is behaved. And that means that people who have big money will put their money in the market because it's not so volatile. They don't want their billions of dollars moving around like a Mexican jumping bean. Do you understand? So the bottom line is that, that's why I've been bullish and looking for call opportunities ever since May. And that has not been a bad thing. Now, we did get a big jump to the downside down to 6,200 on August 1st. Obviously, everybody kept their gains for the month of July, right? And then August 1st, when the calendar changed, obviously then they could do their own selling, which is what they did. So the VIX jumped up to 22. But can you see it ran it right into my purple line, which I knew would be a resistance zone, because that's what the purple line is. It's a reversion to the mean level. So I knew in my mind that that would be a potential resistance for the VIX, which would mean that would be support for the stock market. Well, do you want to see where the stock market stopped? That's why on Monday, the August 1st was totally buy day. Because check this out. You see where it stopped on that Monday? Right on the blue line. So I had two things working for me on August 1st. One, I had a reversion to the mean to my blue line, which you can see since April has never been touched. That's the first time it was touched. And I had the purple line getting tagged by the VIX. And if the VIX is going to come back down like it did, then the stocks are going to go back up. And that's the way I've been thinking. Now, again, the VIX is the key. Didn't I say that? Okay, so let me show you what I'm talking about here. Because as long as it behaves, we can go make new highs. We can keep going. If it becomes unhinged, we got problems. So let's see where we might have problems with the VIX. Let's go take a look, because this could be helpful to you. You have to have some reasoning behind everything, right? Okay, so we can see here that the moving averages on the daily, well, let's start with the 20-year, just so you get an idea. Okay, the moving averages on the 20-year all come in between what? Look at the numbers right in your box there. 16, 17, 18, 19. So anywhere between 16 and 19 is where it has to stay under. Got it? We need, if you want to be bullish, you got to stay under 16 to 19. You get the idea where I'm getting the numbers from? Okay. Now let's go over to the 5-year. 5-year numbers are 17, 21, 19, 16, 19. I see a lot of 16, 17s, and 19s, right? So again, the 16 to 19 neighborhood is where you want to keep it underneath if you want the thing to behave. If you break above 20 and 22, I would be very, very careful about anything. I'd be very defensive, and I'd be planning on a drop, because if we break above 22 and then we break under 6,200 on the S&P, you're going to possibly have what? A very substantial move down. How surprising could it be? It could be just as surprising as that IBM graph I showed you. Where could it possibly be going? I'll give you some ideas. These are called gaps. And you see this gap is at 600. Well, this is on the SPY. I want to put it on the SPX because most people get the S&P 500 on their, on their homework. So let's take a look here. Okay, so where could we have full reversions? Again, we had full reversion to blue, right? So that was a good reversion. So far, so good. That's it. But if you took out 6,200, that reversion would be violated. And then the red line and the green line would be violated, and the blue would be violated. And if you stayed there for any length of time, they'll all roll over. And when they all roll over, like they did in March, you can go way down. So that's why these things are not rolled over. So that's why it's too early to be any type of bearish. But if we did get the VIX above 20, 22, and you got the 6,200, here's your first stop, which is the first gap, which is 6,028. So going around 6 grand would be the next one. Underneath that, you've got another big one here, and that starts with a high point of 5,700. So let's call it 57, 5,800. So you got two possible reversion to the means. It's all according how nasty it got. Right now, there's no evidence of this. So this is not something to stay up worrying about. But you know what? If I'm telling you, if the VIX gets above 19 and 22, start to realize that these other gaps could go get filled. And particularly if it's coordinated with something that shocks the world. The CPI numbers this month might be okay, but the ones in September might not be so okay. Because again, these tariffs are going to be paid by somebody. I have read that some people are saying that 60% of the tariff is now being absorbed by the retailer, which means the Walmart, the Home Depot, those kind of guys. Okay. How long do you think they can take 60% of the tariff hit? And only 22% they say is going to the consumer, with the other 15% is going to the importer, the guy who sent it out. So that could change. And if that changes and the CPI changes, again, they could try to make a speech that it's one time only, but I don't know how that's going to resonate. We'll have to see. But that's a danger. That's a danger. So there's many things that could obviously go right and wrong. Right now, everything's going pretty darn right. They got the tax bill through and everything else, so everything was fine. Okay, but I just wanted to show you, be careful on that. And again, with my market update every week on Sunday night that goes into your mailbox, this is the information I cover. Stocks, what are interest rates going to do? How about the dollar? What is oil doing? How about those global markets? Any opportunity there? How about Bitcoin? Okay, that kind of stuff. Ethereum. So you get a lot of information, and I think from a somewhat informed source, which I think is a pretty good deal. Let's go through in the last 2 months some of the ideas we've had. I'm not going to give you the specific strike prices. I just want to show you why I thought the stock would go. So let's ram through these pretty fast and give you an idea. Again, these all expired in June or July. Okay, so here's the deal on this stock here, NRG Energy. Okay, you see how it's all consolidating here in May, right? So we go out to June and we think it's going to pop. And you see, it got good earnings and it goes from here to here. But you understand why we took our shot? Right there. Okay. Next one up is going to be called Cloudflare. You'll notice they're not in the same sector. The only thing they have in common is the setup that I'm looking for. Okay, that's what they have in common. And it takes a lot of time to find these things. Again, another one in May, consolidating around here. Averages are pointing up. Remember, red, green, and blue are going up. We're going up. And we got a nice big ride out of that one. Next one up is going to be called Roblox, RBLX. I'm sure you've heard of it. These also expired in June. Again, Roblox, consolidation. You see all the consolidation? You hit the gold. I knew it had an excessive reversion to the mean. And then what turned up? Red, green, and blue turn up. This is where you want to take a shot. And a nice little ride you had going up and up. And you could roll them. Rolling means you sell out of the ones you bought, you buy higher ones. You sell out of the ones you bought, you buy higher ones. Goes up to 150. You see it's that far away from the mean. You know it's going to probably come back down, which is exactly what it did. Revert to the mean. A couple of other ones here. I mean, we've had many, so I'm just going through them. Disney, which had a very big move. Disney. Wow. Sometimes my machine likes to give me what they want me to look at. Okay. And then I'm going to get into some more recent ones from July. Okay, so on Disney, can you see it was down here in the consolidation with the averages all coming together and turning up? So we took a shot that this was turning up because I think they had earnings coming out or something. And the bottom line is it was quite a ride. Okay, quite a ride. Some of the more recent ones we had that I put on the alert. Well, Boeing. Ah, I thought Boeing was going to go fill the gap. I always look for gaps. I think gaps get filled. This case, it got filled. Let me show you what the story was here. Okay. You have to look at I look at all different time frames, or else you wouldn't find this. So you wouldn't know unless you looked at the 5 year that there was a gap there, because on the 1 year it doesn't show up. So on the 5 year, I see a gap is at 240. That's my destination. Do you understand? So when this thing turns up, first of all, look at that low way down here. And then once they turned up, you see red, green, and blue are turning up. Then you go out and you buy the 190 call, the 200 call, whatever, and you're looking for what? You're looking for the gap to fill. Once the gap's filled, you take the money and you run, or you can take it along the way as well. But there was a reason why we thought that it would go up there, and that reason came to fruition. So that's another thing that I look for. Turning points, consolidation of the averages. I'm looking for possibly a what do you call it? I'm looking for a gap to be filled, and then bam, because our game is to risk a little and take a lot. These options I'm talking about, the strangle that we talked about, $300 on one, 287 on another, 286, 280. We're not putting up a king's ransom to try to see if we can be right or not. Um, we even have some that were very small in price too. I'd like to show you a couple of those. This thing had a very big move, and it cost $134 to do the call and the put, and it expired on July 6th. And this is Joby Aviation. And can you see why we thought it might run? You see how it's consolidating and turning up? And boy, did it go up. So we had obviously a very good experience with this. We don't know that these are going to happen like this, but we are looking for what we consider to be stocks that have news coming that could really move things, because those are the ones that are most exciting. The Rigetti Computing, the Broadcoms, the Taiwan Semis, and then of course Robinhoods, Upstart, Datadog, Seagate. These are the names. Now, also, we have long-term positions where we go out to December and we do what they call vertical call spreads when stocks are down. You want to know when we looked at something like this on the alert? When it was at 160. This is called not ORD, or it's called Oracle, ORCL. What made me want to go long-term on Oracle? God, hang on here. There it is. Okay. Why did I think this was a good deal? I'm going to show you a couple of them, and then I'm going to be able to sign off. Okay, here's the deal. The Oracle. Can you see it comes down here, right? So we know it's very far down. And then can you see all the lines are turning up? And Oracle's run by Larry Ellison. What are they going to not make money? They've been making money for a long time. So we went out and we did a December call spread, 190 calls, 210, 220. And so sometimes I'll be looking for things that are good companies out of favor. One last one, and that's all I can show you tonight because we have a time constraint. Constellation Energy, check this one out. These guys are the ones that are going to help the data centers get their energy. Can you see when it comes down here to 180, why I'm going to be thinking, hey, this thing is a place to take a shot at it? And look, right back up to 300. All right. What I can tell you right now before we wrap up is I'd like to invite you to, subscribe to my letter. I work with Daniel Sinig over at Trading Indicators. We have a webinar tomorrow, Tuesday. And again, you'll be able to get a link to signing up. It's real simple. It's 3 months for only $297. It includes a class. It includes ideas every Sunday night. And it also, I give you my text number, and you can call and get coaching. And you go, Jim, I'm in this thing. What would you do? Or how do you feel about that? I can't tell you what to do because we give no advice, but I can share what I do. And so the bottom line is I think it's a very small investment. And to be honest with you, I don't think you should do 90 days. I think you should do the full year. The full year is 897. So break it down to be $70 a month. And what are you going to get? You're going to get the course, you're going to get ideas, you're going to be able to talk to me and get some questions answered and understand options a lot better. So again, there'll be a link where you can click on. If you have any questions at all, simply email me, optionprofessor@gmail.com. Singular, optionprofessor@gmail.com. And basically, I'll call you back and you'll ask me your questions and I'll try to provide an answer that I best answer I have for you. And so this is a good opportunity for you. I'm going to be coming around every Monday night to try to give you updates on this. But again, try to get on board because the next one's coming out Sunday. And again, the last one came out just on this Sunday. If you sign up now, I'll make sure you got last week's alert, which had new ideas on it. And then, of course, you'll get my text number so we can communicate. Okay, we're coming to the bottom of the hour. Again, this is Jim, the Option Professor. And again, click on the link to get started or send me the email, optionprofessor@gmail.com, and let's communicate and see how I can help you. Thanks for listening, you guys. I'll be back with you next Monday night. Until then, good luck and good trading.